I have backtested hundreds of strategies. Here are 6 indicators that have made me the most. Now, my apologies for no webcam on this particular video. I'm currently away and I haven't just been able to set up my webcam situation currently. But this thread, I think, went sort of viral. I think it got like 100K-ish views or a bit plus, and I think it was really interesting. I think a lot of people were expecting, hey, this is going to be some 6 really complicated indicators that I've never heard of before. But realistically, a lot of these are very common. I think the way you use them is actually how it's more powerful, and that's why I've been able to use them so much. But first, let's break down what an indicator actually is. So an indicator is just a mathematical calculation used to analyze markets, and it's normally using price data, but obviously that can depend. Now, each indicator normally falls into one of these categories. We have trend, we have volatility, we have oscillator, we have breadth, and we have fundamental. There are no magical indicators, but some do 100% work better than others. And I've just shown a quick image of like what an indicator formula could look like, just to demonstrate the idea that all indicators, there's no magic stuff hiding behind them. It's just data going into them and then being put through a formula, and then there's an output variable or value. And that's all an indicator is. I think a lot of the time when I speak to newer traders, they think, hey, this indicator has a magical source that it's doing. Realistically, not. It's just a formula. It's just a way of displaying some sort of data. Now, obviously, that data can work really well. Like I've mentioned, some indicators do 100% work better than others. But that really doesn't, there's no magical source in itself with just being an indicator. Now, first is VWAP. So this is the volume weighted average price, and it calculates the average price over a market session. So that's normally from the beginning of the day. Sometimes it's with pre-market data, sometimes it's not with pre-market data, depending on your settings. And sometimes you can even apply this on a weekly chart and make it use weekly data, for example. Now, it's mainly used as a fair value over that trading period and can be a level of market reaction. I think a lot of the common times how people look at VWAP, at least in a more statistical way, is hey, if we go 2 standard deviations above VWAP, then we're going to be looking to revert back and fade that kind of reversion backwards, and we're going to take profits or at least take off some position at that fair value of being VWAP. Now, I have tested a lot of strategies along that line, and I do think they can work. But to be honest, I found it most useful looking at VWAP bounces or VWAP rejections. Gauging trends can be good as well. I've never personally found too much success just in purely gauging trends with VWAP. Normally, it has to be a combination with something else, but it can be useful. But for the most part, I try and look at it as a level that could be a market reaction, whether that be that we are 2 standard deviations above the VWAP and then we come back down and hit VWAP and then bounce off it. Now, obviously, you'll probably need a confirmation with something else along there. That could be RSI, it could be any other indicator we mentioned or anything you come up with. But that's normally the common way I've used VWAP. Now, 2 is RSI. So the Relative Strength Index was developed by J. Wells Wilder and published in the 1978 book, New Concepts in Technical Trading Systems. I really recommend you read this book. I've actually read it a couple times now, and overall, it is a simple book and it is definitely a bit outdated, but some of the techniques he mentions, I don't really see publicized that much online, and I think they can really be good for inspiration. Now, are they going to be, incredibly profitable? You'll have to test them and see. You have to do proper backtesting. But for at least inspiration of how you could maybe apply those methods or techniques into your own system, or even with RSI into a new system or strategy of yours, I think the book is definitely worth your time. Maybe just skim read it, look through the index and see which parts kind of like stick out to you. But definitely check it out if you can. Now, it has become one of my most used indicators throughout my strategies. I pretty much have RSI in pretty much all of them. That's depending, but I run currently 7 futures algos, all on the NinjaTrader platform, fully automated, over kind of instruments like ES, NQ, crude oil, things like that. And as I mentioned, 2 common uses I think is divergence and filtering. I have found the most success with filtering personally with RSI. It's a really good way to filter out a lot of trades, and that can be a really useful thing. So fundamentally, if you have more trades, you have more statistical significance, but you also have you need a higher edge because you are paying so much in commissions just because you're taking so many more trades. And normally, if you're taking more trades, that means you're holding them not for very long, which can then mean you need to make up, and you have to have a very good edge to make up for that commissions because commissions is normally fixed or variable. Now, that's not always the case, depends on what broker you're at. But what I've found is I try and build strategies that have a lot of samples, and then I can filter them down from there. Now, obviously, I don't filter them down to where they're only doing 100 trades per year or something like that, where the statistical significance is very low, or adding a ton of ideas to it and then overfitting the whole strategy itself. I try and find just one indicator or one implementation that can filter out a lot of those trades that I'm not looking for with that strategy type. Now, because I do like mean reversion strategies, normally RSI is great for that because RSI really is telling you overextension in basic form. So that can be really good when you're looking for anything mean reversion basis. So to give you one off the top of my head, like if you were to do, hey, it needs to be three green candles and then it needs to be a red candle, or X amount of green candles, then it needs to be a red candle, you'll probably get a lot of samples or trades with that just basic criteria. But if you add then the condition that, hey, it must be above the ATRSI, you're playing to that strategy type. You are looking for overextension or overbought with that, and that really works well. So that's why I use RSI a lot. Now, three is moving averages. Now, no doubt, moving averages are probably the most common thing used to traders. They serve as an easy trend identification method with some of the older strategies built around being above or below certain moving averages. And personally, I still think this is true. I don't apply moving averages to every single strategy of mine, but I do always look to see how it is affected by just applying a very simple trend moving average. Let's just say, a 200-day moving average if I'm trying to build some sort of long bias system or short bias. That can be really easy ways to just filter out trades and see if they're above or below that kind of price. And normally the 200 or 50-day moving average is kind of used as fair price, a fair value as well, depending on your systems. So moving averages, very simple, not much to say on these, but definitely use them in your strategies if you can. Four is Bollinger Bands. Now, this was developed in the 1980s and has become really a staple for measuring price volatility. Normally, people use two standard deviations. Sometimes they do more, sometimes they do less, but I think the most common is two standard deviations. And what I'll say here is definitely take a look at Larry Connor's use of them. He's got some really, I guess not intuitive, but really interesting ways of how he uses Bollinger Bands. So definitely look up. I think some people have already quantified his kind of strategies, so you can actually look up how they've coded them or things like that. But apart from Larry Connor's way of using them, I've just seen great success with applying Bollinger Bands as a sense of telling if price is overextended or overbought. And also, a really interesting one is how it moves around within that Bollinger Band. You can actually have some really good trades trading between the top band and the low band, and that can be a really interesting thing to do. So Bollinger Bands, simple again, but a really good addition. 5 ATR. So this is just the average true range, and it's also a measure basically for volatility. This can be really useful when you're doing volatility breakout strategies, risk management, especially I use a lot of ATR for risk management, and identifying potential trend reversals as well. As I mentioned, it's super simple, but it's very effective. And I've seen many people use ATR just for volatility. Now, definitely there are more complex ways to do volatility and things like that, but I think if you're just going for a simple method, I think ATR can work quite well. My most common use for ATR is pretty much most of my strategies have dynamic risk management, which means the amount of take profit or stop loss is based on the volatility of that time. And a common way I'm measuring that is using the ATR. So as I said, very simple way I'm using it, but it's pretty much used in most of my strategies. So have a look into it if you are building your own. And then six is choppiness index. Now this is probably the only one I think on this list that maybe not everyone will know. It is a bit more of a understated indicator, and not many people have mentioned it, at least to my knowledge. It is a really basic formula. It pretty much just uses ATR and a natural logarithm of price movements over a specific period. While it isn't perfect, it's not going to perfectly tell you when it's chopping or ranging markets. It can be a pretty good indication of it, depending. So normally what I do with this is, as we know, trend following systems, you don't want to be trending in a range market, and mean reversion, you want to be trading in a range market. So this indicator tries and solves that basically for you to be able to identify them. Now, identifying range markets is always going to be a lagging sort of indicator, so it's never going to be perfect. But from the quickest way I could implement a sort of filter to see if the strategy does work with some sort of filtering for choppiness range bound markets, this is normally the indicator I go to. Just because it's so simple and elegant to introduce, it's very understandable. And to be honest, it has worked quite well for me for most strategies. There definitely are more complex ways of doing it. You could probably get even more accurate if you want to spend more time on it. But I think for a simple approach, and if you're definitely struggling with your strategy taking way too many trades in range bound markets, dropping this index could be a good option. As I mentioned at the start, I know that some of this may surprise you as they really are just simple, but I do a lot of my strategies now just rely on price data alone. So that could be candlestick patterns, it could be looking at highs over the past 30 days, things like that, which you don't really need an indicator for. You technically could create an indicator for them, as it's just a formula, but realistically, these are the most common ones that I'll be using. Now, if you want more content like this, feel free to follow me on Twitter. Otherwise, if you can, subscribe or share this with anyone you might find who might find it useful, would be absolutely appreciated. But I'll see you next week with my webcam and everything probably sorted out.